Hi, this is Matthew Cratter from Trader University, and today I want to talk about low interest rates, how evil they are, and the problems that they cause in an economy. If you're interested in learning how to make money in both bull and bear markets and really understanding how the economy works, be sure to hit that subscribe button. So, low interest rates. Why have they been so low for a very long time? Well, this is basically a function of central bank policy. The Federal Reserve, which is a central bank in the US, sets the short-term rates. One of these short-term rates is called the federal funds rate. You can see that it's moved from really the high teens in the early 80s, basically down to zero at this point. And as this happens, what happens is all interest rates follow and move lower as well. So here we can see that the 10-year Treasury interest rate, which used to be above, call it 14 or 15 in 1981, and is now about 0.6, 0.7, depending on the day. In many countries in Europe and Japan, some of these 10-year yields are actually negative. So one problem with low interest rates is they can be what's also called ZIRP, zero interest rate policy, or NIRP, negative interest rate policy, which I'll probably have to do another video on negative interest rate policy because it gets really weird. You can actually get paid to take out a mortgage. Right now, if we look at interest rates in the US on treasuries, which are quote unquote the safest investment simply because the government can tax, the US government can tax, it can print money to pay you back, we can see how low interest rates are. If you want to lock up your money for 1 year, you only get paid 0.17%. So about close to 20% of 1 percentage point. Even if you want to lock up your money for 10 years, 20 years, or 30 years, you get paid a measly 1.46% in terms of interest. And this is clearly below long-term inflation rates. And so you're actually, if inflation's at 2% and you're making 1.46% a year, you're actually losing money over time. So who do low interest rates hurt the most? Low interest rates hurt retirees. They hurt people close to retirement who don't want to take a lot of risk with their capital. They don't want to put it in crazy tech stocks. They just want to put it in a savings account because they know they're going to need it for retirement homes or medical bills in a few years. And as a result, if you're making 0% on your money, it can really screw up your retirement plans. So it hurts poor people. It hurts retirees. It hurts young people who are trying to grow their capital. If you're trying to save money every year, you're really forced into riskier investments. Now, who benefits from low interest rates? Well, it's pretty easy to guess. It's rich people. It is hedge funds, institutional investors, a lot of the buy side on Wall Street. Here's an example. I don't mean to pick on Hugh Hendry, whom I actually think is a pretty cool guy. But what he's using low interest rates for, and he tells everyone, is he borrows at 2% or less, and then he buys luxury real estate on St. Bart's in the Caribbean. And this is very rare. It's a scarce asset, a little bit like gold or silver or Bitcoin. And so this rare luxury real estate goes up a lot. He gets to live in a tropical paradise, and he finances it at very low interest rates. It's very difficult for other people to get. So low interest rates are good for the status quo and for rich people. Now, they hurt everyone simply because the lower interest rates are the more debt governments, individuals, households, corporations are incented to put on. Because if as everyone knows, if the interest rate's lower, you can borrow a lot more money. So this is federal debt in the U.S. This is basically Treasury debt, the total public debt. We can see how it has skyrocketed since the 1970s. Even if we look at it, if we adjust for it, look at it as a percentage of gross GDP, nominal GDP, we can see that we've moved from a level of, call it around 40% in the 60s, 30% in the 60s, all the way up to, this actually stops, it looks like this stops above, I would say above 100% at the end of 2019. This doesn't have the early 2020 numbers. But this means that the total government debt as a percentage of GDP, it's actually greater than the total GDP. Likewise, corporate debt, this is non-financial corporate business debt, has skyrocketed as well. This leads to very levered companies that can blow up. The banking system in the U.S. was very levered going into the 2008-2009 crisis. It required a bailout that we all paid for with taxpayer funds as well as with printed money. So low interest rates encourage a lot of levering up. They encourage governments to do irresponsible things. They encourage people to do irresponsible things, to borrow more money than they should be borrowing, and relying more on borrowing than actually productive labor. Now, it's hard to fault working class or middle class people for this too much when the very rich are using low interest rates to get even richer. But the difference is rich people use low interest rates to finance asset purchases that are appreciating. Working class people tend to use low interest rates to buy depreciating assets like cars, motorcycles, RVs, things that you might derive some pleasure from, but they will not help you to get rich over the longer term. Now, low interest rates also lead to a lot of strife between the different generations. And so I think a lot of what we see, the kind of back and forth between boomers and millennials, I happen to be Gen X, so I'm kind of in the middle here. But a lot of this has to do with the fact that as interest rates came down over the past 30, 40 years, it really created a tailwind for investors. So if you started investing in the early 80s, you might have been smart, but you were also extremely lucky, because as interest rates go down, bond prices go up, stock prices go up, real estate prices go up. And so in the late 80s or in the 70s, you could take the money you earned by mowing a lawn, put it in stocks, and do very well. Right now, there haven't really been cost of living adjustments, and so there's no way you're going to finance your Stanford or Harvard tuition the way some people did by mowing the lawn or investing in stocks, etc. And so what we have is a situation where valuations have kind of moved to a permanently higher plateau. The S&P 500 is very expensive, but it doesn't seem to really go down that much during bear markets and recessions. Housing prices are very expensive, especially in nice areas. They don't seem to really move down too much either. So it's very difficult. Low interest rates are good for people who are already rich, who have a lot of assets. It keeps asset prices propped higher. But if you're trying to get on the elevator, the wealth elevator, it's very difficult, because if you're buying a stock index at a PE of 25 or 30, unless there's a lot of growth, you're really not going to make as much money as if you were buying the stock index back in the early 80s when the PE was like 9 or 10. Now, what a lot of people don't realize is that low interest rates do not actually help the economy. They do not stimulate GDP growth. We can see this is the nominal GDP rate. It's obviously going off a cliff here because of COVID and the lockdowns, but GDP growth rates have moved lower every decade for the past, call it 40 years or so. If we look at real GDP growth rates, we can see that there's been less volatility in them, but also the peaks have been much lower. So there's a great paper which I'll link to here by Richard Werner and Kang-Suk Lee that talks about how if you actually look at the data, nominal GDP and low interest rates are actually basically lowering interest rates does not stimulate nominal GDP growth. This makes a lot of sense. We've seen it in Japan, where interest rates have been very low for a very long time, and GDP growth rates are still very sluggish. Likewise in the US and in Europe and most parts of the developed world. So when the Fed says they're going to stimulate the economy by lowering interest rates, it does stimulate the stock market. It makes rich people who own stocks and real estate richer, but it does not help the overall economy as you would expect. It's sort of shifting around future cash flows and their discount. The real way you grow an economy, the real way you grow culture and civilization is by increasing productivity, by creating Excel, by creating the PC or the iPhone, by creating or discovering antibiotics, by figuring out ways to get us into space using private rockets, figure out how to get to Mars, etc. This is what actually grows an economy. Entrepreneurs, inventors, engineers, physicists. It's not central bankers. It's not investment bankers. It's not hedge fund managers. So we've already sort of covered this, but low interest rates discourage saving. And we could debate whether we're talking about nominal low interest rates or real low interest rates. People really take their their cues and their price signals from nominal interest rates, which is just sort of the interest rate you see there, not adjusted for inflation. But basically, if you're young and you're saving money or wanting to save money, if you're only making 1% in your savings account or a lot less than this, you're not really incented to save. And so you're more incented to spend it on maybe a new car or motorcycle or something like that, which will not increase your wealth simply because it's a depreciating asset. It's not an appreciating asset like stocks or like real estate. So that's what happens on the personal level. In some sense, we do need low interest rates to stimulate consumer personal consumption, because most of our GDP, something like 2/3 of U.S. GDP, comes from people spending stuff. It leads to the kind of empty, vapid consumer culture that we have now, where life just consists of buying more things, spending a lot of money at the mall, putting it all on your credit card at low interest rates. This is not how great civilizations are made. Great civilizations are made when people are producing, when they're producing art, they're producing music, they're doing science and research. But our current fiat money system with low interest rates, it encourages empty consumption. And we sort of have to keep this empty consumption going to keep US GDP going, unfortunately, under the current system. So that's sort of how it plays out at the individual and societal level. At sort of the corporate level, low interest rates encourage what a lot of Austrian economists call malinvestment, where mal just means bad investments. So when nominal interest rates are higher, let's say interest rates are at 5 or 6% like they used to be in the late 90s, early 2000s, you will look, if you're borrowing at 5%, let's say you can take out a loan from the bank at 5%, you're only going to look at projects that have higher returns on investment than the interest rate you're paying. So you'll look at really interesting projects that may have returns of 6 or 7% or 10% or 20% or whatever it is. But when you lower nominal interest rates, let's say interest rates are at 2%, you're a big business and you can borrow at 2%. It's very difficult for individuals, except for people like you, Henry, to borrow at these low rates. You'll look at just more low return investments that have a lower ROI that return maybe 3 or 4%. And these tend not to be things that really move the needle for the economy. You end up with a lot of investments, which we're going to talk about in 1 second, investments like Uber and WeWork and these sort of crazy things that we've been seeing. So I'll link to this Wikipedia article on malinvestments and what Mises had to say about it. Let me just really quickly walk through how low interest rates work to push people into more risky investments. It pushes individuals, it pushes corporations, it pushes pension funds and other institutional investors. But let's say you've been making a nice 3% on your savings account. Back in the early 2000s, I remember making 5 or 6% on my savings account. But let's say you're making 3%, all of a sudden interest rates basically get cut to zero, and now you're making something more like 1% if you're lucky. So you realize, well, especially if you're maybe a retiree, this isn't enough to earn on to live on. I was counting on making 3% a year from my savings. Now I'm only making 1%. So maybe I should diversify into some dividend stocks, maybe some conservative blue chips like Coke or McDonald's or Starbucks or something like that. Or maybe some higher yielding, more risky dividend stocks. Or maybe you're pushed into corporate bonds. Well, let me put it this way. As these people in their savings accounts invest in dividend stocks like Coke, it pushes down the dividend yield. And so then people who were previously in dividend stocks have to maybe look at higher yielding corporate bonds. Maybe they have to look at junk bonds. They get pushed out what's called the risk spectrum in an effort to either get higher yields or higher returns. And ultimately, a lot of this money ends up in more early stage risky investment, and not really smart investment. It's not the kind of stuff that's where we're trying to figure out a cure for cancer or good things like SpaceX. But you get these monstrosities like SoftBank, which just have too much money from people who've been really pushed out the risk spectrum. And so you get all these examples of malinvestment like WeWork, Grubhub, Lime, Uber. I'm not sure all of these are SoftBank companies, but you get the general idea. And this can have a lot of unintended consequences, besides the fact that it creates these big individual bubbles, like in WeWork, which was valued at, 60 or 70 billion, and now it's probably has a negative valuation. Just a lot of capital destroyed that could have gone to more productive uses. but you also get some unintended consequences. I'll link to this article on DoorDash and pizza arbitrage, where basically DoorDash was using VC money to subsidize the price of pizzas for customers, created a lot of really weird effects. It's a very good article. You can have unintended effects like the fact that venture capital money for the past few years has been making Uber and Lyft fares cheaper than they would otherwise economically be. Now, why is this money in venture capital instead of sitting in maybe public equities? Well, simply because people have been pushed out the risk spectrum by low interest rates. And so what happens when Uber rides are cheaper than they should otherwise be? Well, this has knock-on effects. It means there's more traffic. It means there are fewer people taking public transportation. And so these sort of public services suffer. And there are a lot of knock-on effects when you set the price of money artificially low. And again, it's central bankers doing this. It's our entire crazy system. They tell us they're doing it to stimulate the economy, but we can see the effect of lower interest rates. It's made the rich richer, and it's made the poor poorer. It's gutted. It's produced a lot of less productive companies, and it's led to a lot of just very weird arbitrages, like seeing Lime scooters all over the street, and obviously sort of unproductive uses of capital. But unfortunately, central bankers only know how to do one thing. When the economy is doing badly because of low interest rates, they will just fix it with more low interest rates. Now we've reached the point where we're actually printing money and buying assets with it. So we've gone one step further. Central banks are actually creating money out of nowhere, using it to buy junk bonds, using it to buy U.S. treasuries, and monetize the debt in various countries. And so this is sort of the natural end of the fiat money system that we're seeing. This is why gold is doing so well. This is why Bitcoin is doing so well. When you see gold and Bitcoin doing well, do not think things are good in the world, even if stocks are going up. There's something very, very wrong. Bitcoin and gold are the thermometers, are sort of the smoke detectors in your house that tell you there's a fire somewhere. And even though the central bankers are smiling, if you look out your window, people are rioting. This ultimately leads to a lot of social unrest and possibly revolution and war as well. This is why low interest rates are not benign. They're actually extremely evil, as are central banks. So that's a lot there. Hopefully you guys found that useful. Hit the subscribe and like button if you did. Let me know your questions and comments in the comment section below. And thanks a lot for watching. I'll see you in the next video.